For decades, it's been the ultimate showdown, right? Man versus machine. But what happens when that battlefield is Wall Street, where fortunes are won and lost in the blink of an eye? Today, we're going to dive into this really cool academic experiment that pits a learning AI against the Dow Jones. The question is pretty simple. Can an algorithm actually beat the market?
Look, anyone who's ever bought a stock knows this feeling. That thrill when it goes up, the absolute panic when it plummets. Trading is hard. And it's not just because the market is complicated, it's because, a lot of the time, we are our own worst enemy. Our psychology just gets in the way.
And that right there leads to the big question. What if you could just take out the human element? Take out the fear, the greed, the gut feelings? Could a machine, a piece of code that feels absolutely nothing, make better decisions and, at the end of the day, make more money? This quote, and this is from the actual research paper we're looking at, just nails it. It highlights the exact weaknesses that machines just don't have. An algorithm isn't distracted because it had a bad night's sleep, and it's not going to chase some hot stock tip it heard from a friend. It just follows the logic.
Now, this whole idea isn't brand new, right? For years, we've been using computers to automate trading. And this is kind of the first step in the solution, algorithmic trading. Basically using pre-programmed rules to place trades way faster and more efficiently than any human ever could.
But it's not some magic black box that just prints money. A modern trading system is actually more like a highly specialized team. You've got data coming in one end, and it goes through a whole series of modules, each one with a very specific job, before a single trade ever gets placed. And each one of these modules plays a vital role. The alpha module, that's the brain, always looking for opportunities. The risk module is the guardian, making sure things don't go completely off the rails. You've got an accountant for costs, an architect for the portfolio, and finally, you have the hands that actually execute the trades. It's like a full-blown assembly line for making financial decisions.
But what if the system could do more than just follow a set of rules? I mean, what if it could actually learn from its mistakes and get smarter over time? Well, that's where we're headed next. It's the next frontier, reinforcement learning.
So what in the world is reinforcement learning? Well, to put it simply, it's a way of training an AI through pure trial and error. You drop an agent into an environment, you let it take actions, and then you give it a reward or a penalty based on how it did. It doesn't have a rule book, it has to write its own by figuring out what works.
Okay, the best way to wrap your head around this is to think about a video game. You don't sit down and tell the AI, okay, press A to jump, then B to shoot. No way. You just tell it your only goal is to get the highest score possible, and then you let it play millions and millions of times until it figures out the patterns all by itself.
So let's apply that here. In our case, the game is the wild, chaotic world of the stock market. Our player is the AI agent. Its only possible actions are to buy, sell, or hold stocks. And the high score? That's simple. It's the portfolio's profit. The AI's one and only goal is to make that score as high as possible. Which brings us to this specific master's thesis from the University of Zurich. A researcher basically set out to do exactly this: build an AI player, unleash it on one of the most famous stock indexes in the world, and see if it could actually win the game. So here's the setup. The AI they used was a specific algorithm called A2C. Its challenge? Manage a portfolio of all 30 stocks in the Dow. The goal was simple: do better than just buying and holding the index. And the only info it had was daily price and volume data, plus a few standard technical indicators. Nothing secret, nothing fancy.
Now, this is really important. To make sure the AI wasn't just getting lucky, the researcher tested it in two totally different environments. First, a super volatile period between 2020 and 2021, with all the pandemic fears and election chaos, and second, a much calmer, more stable period from 2019 to 2020. It's like testing a driver in a crazy blizzard and then on a clear, sunny day. You want to see how it handles both.
So the moment of truth. After all that training and all that testing, how did our AI player actually do? Did it learn the game of Wall Street, or did it just crash and burn? Let's check out the results. But first, one quick, super important term: alpha. When you hear alpha, just think outperformance. It's that simple. If the market index goes up 10% and your portfolio goes up 12%, you've generated 2% of alpha. It's the measure of how much better you did than the benchmark. This is our AI's final score.
All right, here we go. In that chaotic, volatile market, the blizzard, the AI didn't just survive, it totally thrived. It managed to beat the Dow Jones index by an expected 5%, Now, in a world where most professional fund managers struggle to beat the market at all, that is a huge win.
Okay, but what about the calm market? The sunny day? Could it still find an edge when there wasn't as much chaos to take advantage of? And the answer is yes. Even in that more stable period, the AI delivered a positive alpha of 1%. So it proved it could find an edge no matter what the weather was like.
So there you have it. The experiment worked. The AI, trained with this video game method, successfully beat its benchmark in both a volatile market and a stable one. And, this is critical, this outperformance was still there even after they factored in all the trading costs.
So what does one academic paper really mean for the future? Well, look, while this is just a single study, it points to a really powerful trend. We're moving beyond just automating simple tasks. We're creating systems that can learn, adapt, and strategize in incredibly complex places, like the financial markets.
This quote from Dr. James Simons, who's an absolute legend in quantitative trading, it just says it all. The real power here isn't just about the fancy math. It's the ability to remove emotion and to approach the market with a systematic, disciplined, and scientific mindset, which is something this AI does perfectly.
This one experiment shows that a machine can learn to find an edge. So, as this technology gets smarter and more powerful, and it will, it leaves us all with a pretty fascinating question to think about for the future. When it comes to your own money, who or what are you going to trust?